Good afternoon, everyone. Welcome to our 2020, the first session, I think, of our global investment strategy outline for the year. So we are very aware that effective from Monday, the different portfolio managers within Apex Investments Consulting are going to start visiting you at your offices through online engagements for a continuation of this session, except for those particular meetings. We don't really spend a lot of time on this particular part of the meeting. We go straight into your portfolios. So with that understanding in mind, this is pretty much the most detailed outline of our views we will give. And then in your meetings, it will be as detailed as you sort of want to. So I'm warning you that although this webinar, I think, is blocked out for 2 hours. Firstly, I'm not going to use the whole 2 hours. I intend to use maximum 90 minutes. And then I also just maybe want to say in those 90 minutes, the gist of my message, I'm going to really do everything I can to deliver it in the first 45 minutes. And the many of you that are familiar with my presentation style, I also believe in understanding by repetition. So the first 45 minutes, I'm going to deliver the gist of the message. The next 45 minutes, I'm going to repeat the gist of the message with different slides. So if you can stick it out for the first 45 minutes, you've got the message. And then the later part, I'll just be repeating in a different context. You may not pick up that I am, but I actually will be. So I'm going to deliver the message twice, if I mean to give you some comfort. So the format of the presentation really hasn't changed. Where I am going to spend a lot of time is the first four parts. This time around, I'm going to spend a lot of time on section one, which is our philosophy and process. To give you a very good idea why I want to do that is you're all quite aware that we follow what we call a macro regime-based asset allocation process. This means that as much as we understand what is going on with global macroeconomics, and that is one of the four pillars we use, as much as we're very aware of what's going on with short and long-term valuations at asset class level, and as much as we are also very aware of the valuations short-term and long-term at the currency level, when we get to very extreme points of the earning cycle, we override that and position for the earning cycle. So a very good example, which I think many of you on this call have experienced, is that in May 2022, when the yield curve inverted, a signal that the Fed was now going to restrain global demand so as to control inflation and pretty much cause a recession if that was necessary. Our portfolio, we sort of did an override and introduced dry powder worth about 15% across all the mandates. When that yield curve uninverted, it's now almost about 12 to 18 months ago, we started adding risk quite aggressively into your portfolios. And then the second part of this is that when specific earning cycles that have been depressed for a long time start to respond to monetary policy and they start to inflect or to bounce, we again override the process and we make sure we are sitting with a risk on strategy. It is my delight, I think, to sort of let you know that we believe, as far as South African earnings are concerned, China earnings are concerned, emerging market earnings are concerned, global commodity cycle is concerned, those earnings have inflected, which means that there is an element of override to make sure we're positioned with a neutral risk appetite so we can play into those earnings. So I'm going to spend a lot of time just talking to the process and philosophy, but using real life examples because that is informed the core of our decisions. I'm not going to spend a lot of time on section two and section three because this has been a very constant feature of our presentation. So you'll get those slides, even if I say that in 5 seconds per slide. And then on recommendations, I'm going to slow down a lot. And then after that, I'll have a quick look of how we performed over the last year. And then this is the point where I go now into repeat mode. So by the time I say I'm starting the GIS summary, it's another way of saying I'm now repeating everything I've been saying from section one to section four. So when I finish section four, you can be rest assured you've got the gist of the message. And then section six, I'm going to repeat it using different slides. And then I'm going to do a repeat of recommendations in section eight. So you can see section four and section eight are repeats. So this kind of gives you, I think, a good sense of where I want to go today. So first 45 minutes, you got the gist. Second 45 minutes, I repeat. It's a pity this particular session because we are speaking to all of our clients. We don't really allow for a Q&A session, but maybe this is something we may consider to make use of the 4 hours. But nonetheless, I only want to use 90 minutes. This is our universe. I think that you're all very familiar with. A key part is that we're looking at all the same asset classes in four geographical regions from South Africa to mainland China, which we know is completely underrepresented in all of the MSCI indices, and it's got a very different low beta profile that brings great diversification to our global investment strategy. We obviously watch out for the currency risk implications, and all of this is captured in different documents from the local house view where my case is to the offshore house view to the macro regime, and you will be receiving the detailed separate house view documents effectively on Monday because they are done with editing. They're ready for us to press the button. We're just not so sure it's a good idea to bombard you with this on a Friday afternoon, but come Monday morning, you're certainly going to receive all of these documents. We have a decision-making process that is divided into two. So into two aspects. The first two part, which is the macroeconomic environment and the business cycle evaluation, otherwise referred to as the macro regime, are pretty much top-down processes. When you want an immediate view, for example, like a view for the next 6 months, a view for the next 3 months, a view for the next 1 year, 2 years, up to 3 years, Pillar 1 and Pillar 2 carry a lot more weight for such short-term views. When you want a valuation pillar, you kind of need to lean into Pillar 3 and Pillar 4, and you would know that the most potent horizon for valuations is a 3 year sort of outlook. And I think to the extent that we are a macro regime process and there's a lot of macro regime inflections we're identifying this quarter, much of our decisions are actually leaning out of Pillar 2, which is where I'm going to spend a lot of time. But for completion's sake, I'm going to touch on the other pillars. So for an immediate view, I think Pillar 1 and 2 are very informative. For a longer term view, your bottom-up valuations are informative. And everything that you're seeing in this dark gray is pretty much now portfolio construction to say, okay, so how do the equity investment styles look like? How do the different geographical regions look like? And what does it mean when implementing into a mandate? So these are all implementation decision strategies, and they're not necessarily idea risk profile evaluation or else equal. In all of those four pillars, we've got the same standardized tactical TAA risk methodology. You're very aware of this one, so I'm not going to spend any time on it. But I just want to use this example to show you how our multi-pillar approach, where Pillar 1 and Pillar 2 affect the immediate short term, which is 0 to 3 years, make up 50% of the TAA signal weight. And then 3 and 4, which are bottom-up valuations, make up the other 50%. And essentially, these are equal weighted, which is like what 91 would call back in the day the four-factor approach. And we would pretty much call it the multi-pillar approach. So if you look at developed markets, an example, we bring in the macroeconomic score of minus 0.81. We bring in the business cycle score, which is a US economy score here. That's why you've got the same figure across geographical regions. And this is the biggest development this quarter, where you would know for the longest time the score was -1 and worse, meaning that recession risk was elevated. So -1 divided by 3 levers of movement would be a 33% risk. -2 is a 67% risk of a recession. And then -3 means that our process thinks there's a 100% chance we're definitely entering into recession, which is what it looked like in 2022 and 2023. Today, if you look at -0.033, if you divide that by 3, you kind of get an 11% probability of a recession, which is significantly low. This number was -1 for the whole of last year and a little bit of 2024, and we couldn't move your portfolios to have a risk-on stance because that was like hindering us. But now that it has moved from -1 to -0.03, it has released 0.67 worth of risk units. If you say 0.67 times our standard TAA step of 5%, this quarter we've got 3% to take away from recession hedge assets like DM bonds, DM IOBs, and bring them to the growth asset of choice. And if you ask us what is that growth asset of choice, and you look at the Q1 scores, I mean, starting from developed markets all the way to South Africa, you'll quickly pick up that the best idea there is the Chinese equity market with a score of 0.31. The next best idea is South African equities with a score of -0.32. And then the final best idea is Japan with a score of minus 0.36. You will know from our philosophy and process, we round off in steps of 50 basis points, meaning that anything between minus 0.5 and positive 0.5 is a zero, and it will be considered risk neutral to constructive if monetary policy and fiscal policy settings allow. So that 3% I talked about, where we have been given by our process because of Pillar 2 improvement, the candidates for that is Japan, China, and South Africa. I'm going to sort of like leave you hanging for now. But as I speak, you're going to start to pick up how, when we talk about overweights in Japan or China and South Africa, you're going to know where it's going to come from. When you look at the scores for developed markets, minus one, you can tell this is still saying have a 5% underweight. If you look at USA, the score of minus 1.55, it's kind of telling you that this is now almost a 7.5% underweight. DMX USA, it's telling you this is a 5% underweight. Europe, that score is saying to you that's a 4 to 5% underweight. UK, that's a 5% underweight. Emerging market, this looks like also like a 3% underweight. So I think you get a sense of like I think where we're sort of sitting if we bring in the multi-pillar approach together and we use a real life example, which is your Q1 2026 score. So I've kind of given you a hint of where we're going with our risk appetite, but let's keep on moving with the process. Before we do this, I just have like one thing I want to drop off with you before I move on. I want to show you this US score, which we're sitting at minus 1.55, which is pretty much almost like 7.5% underweight. The question we want to leave you with now before I move on is, if I told you that for 12 consecutive months, the US dollar was weakening and providing beautiful stimulus to the US economy, and then I tell you that for the whole of 2025, the Fed was cutting rates, I think about three times, if not more, and giving monetary policy stimulus to the US economy. And then I tell you for the whole year, the fiscal side was also giving a lot of stimulus. And then I also tell you for the whole of 2023, 2024, 2025, mega capex projects were being announced in the USA. So, if you announce a capex project of 250 billion, you want to build data centers worth 250 billion, you start ordering the cement, the copper, the platinum, like the whatever is needed, and then you start to roll out. So this is an economy where for 3 consecutive years, like almost every month, one big project after another is being announced. And then I tell you that there was a big, beautiful act that was approved last year for execution this year, and it might result in tax refunds when the tax season starts in USA of $400 billion to the US consumer. So this is an economy that got $400 billion dollars worth of capex last year and is about to get $400 billion because of tax rebates because of the big, beautiful act. And if I also tell you that President Trump wants to give about $2,000 a check of tariff checks because of the revenue he got last year to campaign for the midterm, and then I also tell you he's going to give extra checks so that the housing market gets stronger. And then I say to you, would you implement this 7.5% underweight with a lot of confidence, knowing that there's a policy tsunami that is about to cause another macro regime jump upwards? That my answer or my suspicion is that maybe you will implement that with a lot of caution because there is no way such a mega economy that translates policy so effectively gets so much stimulus from so many angles and the earnings don't respond. So I'm kind of giving you a hint that when you think about it from a macro regime perspective and you look at the policy stimulus that has been imposed onto this economy since 2023, the one mistake you can make in 2026 is to bet significantly against the US. So I think that's a message I just want to leave you with, and I'll build up on it as we proceed. You all know that we apply the four-factor approach across many different mandates. We look after at least 30. We've got a one-size-fits-all approach. We do not follow a one-size-fits-all to mandates. We prefer to give different options. So if you look at this mandate, some clients will say, I just want to have an asset allocation that is always close to the peers in my category, which is the peer group replication. Some will say, I want it, but please don't talk to me about property. I don't want to hear about EM. Don't even bother talking about China because I'm going to kick you out of my office. Give me something basic that a basic client base can understand. We'll give you that benchmark. If you say EM in China, I will not do, but property, maybe because it's prominent in South Africa, I can do, we will give that to you. And then if you say, give me everything you have, your best all-in-one solution will also give that to you. So pretty much a lot of flexibility, but the same process would sort of filter into the conversation. Our job is to give you like diluted investment objectives, but we know that without clients, you don't have business, and therefore we also don't have business. So we really are very comfortable with your clients coming in to alter those calls. We also know that for your business to run, there's specific requirements that you need to meet, and we're very happy again to meet you at the middle ground. And then that's the purpose of the meetings we're going to have to on an ongoing basis. Now, coming back to process, we really prefer like that as long as the risk of a recession is not high, we want to be at least risk neutral. I already gave you a hint that that recession risk has dropped from 33% to only 11%, meaning that if we are at least risk neutral, we're going to have to step it up a little bit. And that's effectively, I think, what we've done. And if you sort of look at this particular process, and I'm going to show you the 10 versus 2 here, where my cursor is kind of making a lot of noise, so you can kind of see what I'm trying to say. The point where we start de-risking is when the yield curve crosses out of the lower black line. This is a recession risk territory. The point where we start adding a lot of duration risk, which is DM nominal bonds, DM ILBs, SA nominal bonds, SA ILBs, SA property, and global property. Those are duration risk assets, which do well when your bond yields rally, is when the yield curve inversion starts to reverse. And I think you'll see that we first started making a lot of noise about bonds. Then we started to make a lot of noise about IOBs. Then we started to make a lot of noise about your property. And then only recently, like when it hit the black line, which means that it's no longer negative, it's now zero plus, we started to make a lot of noise about getting your equity to neutral. Guess what? We are now about to enter that orange line, which is a signal of expansion. And it shouldn't surprise you that we're now making a lot of noise around B risk on. So from this particular signal, we are now entering get ready for risk on. This one is saying slow down a little bit. And then the last one, which is the Fed, is saying it's actually like saying your portfolios must move into risk on territory. How did we do that? That improvement released 3% of risk. We reduced it from recession risk hedges. What are recession risk hedges? The very same classes we started to add when we got to the peak of inversion, which is DM bonds, IOBs. We're reducing these by only 1,5, which means you stay with some. We're reducing DM real estate by 1.5. And if you add those two, we get 3%. Where does that 3% come to? We're bringing that 3% to South African equities. You're obviously going to ask me a question, but dude, you just showed us that Japan is a candidate, China is a candidate. How do you get to choose South Africa out of those three? Hang on tight. There is a space where we're going to bring in China. There's a space where we're going to bring in Japan, and you're going to sort of pick up that. But the first decision of this quarter, as our signal is saying now, get into expansion positioning, we have added 3% into South African equities from DM bonds and DM IOBs. We obviously know since 2022, DM bonds, DM IOBs, DM property have not yet recovered their 2022 losses. They're still dead cheap, a dripping loss, if that's what you want to call it. And most of our clients will say, look, I can give up DM bonds, but my property, absolutely no way, because when this thing explodes, it's going to explode. And that's correct. So if you're in that camp, you don't have to sell 1.5 of property, get all of it out of your offshore fixed income and bring it to SA equity to reflect the fact that the macro regime signal is now saying go into expansion positioning. I think that's the first thing. This now means that officially 2026 is when we move from a capital defense, where at best we're neutral, and we're now going for capital offense or capital growth. And that is firstly being reflected via South African equities. But hang on, I've got other things I think to share with you as we go on. Based on the manner I was speaking, you would have been very surprised if the green arrows that are showing where we are were in euphoria. You should have also been very surprised if it was tightening, because no one is talking about hiking rates. You should also have been surprised if I was talking about a crash, because the recession risk is positioned. In fact, you should be challenging us to say, why does my portfolio not have a flavor of a bounce moving into expansion? Like a bounce neutral, at least neutral, expansion overweight. Like, why am I not experiencing a bounce to expansion? So you're going to see in a lot of the conversation, there's going to be a bounce to expansion vibe across all of your mandates, but it's from a process perspective. And I think that's sort of the message I want to leave with you. If anything, should like stay with you. This picture should stick. And you can see like it's coming from signals that we are following through very, very diligently. The next question is like, dude, don't talk about a bounce. Show it to me in a visual way. Don't use like a smart language. I want pictures. So if you look at the S&P 500 now, this is the part which gets very interesting. You can see the yellow line represents our 2026 earnings, and then the green line, I'm going to call that olive. You all know I'm colorblind right now, so I'm not going to be ashamed of that. But let's just call it the olive line. You can see that it's got this like big jump going into 2027. Where could that be coming from? Where could it be coming from? You all know that monetary policy has got an 18-month transmission line. We started cutting rates in September 2024 to like so there's 3 months and then 12 months in 2025, and then when we finish March it's now the full 18 months. So all the rate cuts are now starting to feed into that economy. We're not even talking about the apex, sorry, the capex stimulus that has been happening for 3 consecutive years. We're not talking about that 400 billion of tax refunds. So there is some jump that is going to happen to US earnings. This is now the question I said, would you comfortably just implement a 7.5 underweight, knowing that there could be this significant earnings tsunami that is about to come through? Mind you, we're not even talking about exponential growth in the AI story. That is still the most controversial subject. So, I mean, if I look at the Alphabet results, on the one hand, they say, guys, since we saw you last quarter, our order book has grown by 240%. And for us to fulfill this order book of 200% in orders for a quarter, we're going to have to spend a lot more on capex. And then all the market had was too much capex. And no one said, like, guys, who has 200% growth in orders in a quarter? So I think if you kind of look at this, I'm leaving you with a message that we are brave, we are processor daring, but there's absolutely no way we are not gonna consider that the US can come back with a vengeance this year or next year. When you show me such a jump, I would rather not have any market timing pressure on my side. I want to make sure I don't regret not doing something about it. So you're gonna see as I speak to you, there is a strategy where we're saying we cannot tell you that it's impossible to have such a jump. We also cannot tell you it's clearly obvious we're going to have such a jump. The fact that we can't be too negative or too positive about this means we need to have a middle ground, maybe exactly where this arrow is. And later on, I'm going to give you a decision where we bring in a little bit of the S&P 500 to reflect this. We're not going to bet against it, but just hang on up to that. So in terms of emerging markets, you can see if you go back to 2023, like I think that final bottoming out happened in September 2025. We had a bit of an inflection, and you all experienced great performance last year because of that. And the question now is will we have that continue? Is that going to have escape volatility into an expansion? And if you look at this jump, it looks like that is the case. And if you remove China, the jump becomes very, very pronounced. And then if you look at South Africa moved ahead of its EM peers and is looking great. So I think the message we want to leave you at is, remember, I started the presentation by saying we look at 4 geographical regions, DM, EM, South Africa, and mainland China. And this gives you a sense that in all of those things, we're experiencing a bounce, and that is likely to move into an expansion. And that is it. So if we kind of think about it, the gist of my message is actually done. But let's see if I can sort of share a few more new insights. Let's look at this USA story because I've given you a policy side to it. And you're going to say, okay, show me the earnings. Like, where is the money? If I look at the hyperscaler, we're kind of seeing numbers of 34%. And if you sort of do the maths with the S&P 500 forward PE today, and then you say, how much earnings growth should we have for this market to be fair value, you get an answer of about 35%. So if these do come through this year, that market is fairly valued. So that's why we're sort of worried about using the historical earnings to go into a 7.5% underweight, only to realize that had we been aware of almost like a doubling up of earnings, we would not have taken such an aggressive bet of reducing DM by 7.5%. So that's a message I sort of want to leave you with. The other number I want you to keep in your mind now is this 15% anticipated earnings for the S&P 500 this year. Fifth 18% for the S&P 400, which is the 400 stocks after the 500, and then 16%, which is the 600% after the 900, and then after that we get into the Russell 2000. So just keep those numbers of 15% in your mind. I'm going to come back to USX hyperscalers later on, so I'm not ignoring that, but you're going to pick up that I have. So I've kind of like asked you to keep a mental note of 15%, a mental note of 35%. And I'm kind of showing you a Russell 2000 that has been bleeding, I think from 2018, underperforming, 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 and then has a bounce. When you bounce in our process and we start to ask questions from our strategists about what the earnings number does, and they say it's 67%, trust me, the whole team is like anxious. Like a bounce followed by 67%. I'm not going to miss that action. I want it now. So I'm starting to give you another hint. We have been talking about global small caps, but this evidence that it might be turning around confirmed with expectations of 67% makes us excited. We just want this to be 15, actually, to be honest with you. It doesn't have to be 67, but if it is, we will do it. What do we do in our portfolio construction? We're not going to say 67 is impossible. We're not going to say 67% is guaranteed. There is always a middle ground to every story, and this is where my cursor is. And you're going to see us looking for that middle ground for your small caps, and we're going to execute it accordingly. Now, I kind of trashed valuations. I wasn't. We know from our process, if you say every time there's performance, how much can you comfortably say it was because of valuations in the first year? It's about 5%. How much can you say might be valuation informed within 2 years? About 20. Within 3 years, about 25. So this is where I was saying the inflection of earnings and the expansion of earnings the year after matters a lot more to us in our process in the immediate short term than the actual valuations now, because the bounce confirmed by expansion means that valuation picture is going to change aggressively. So this is why you're going to see me saying our positioning is really following process, even though you can accuse us that some of the things we're doing are ridiculous if you look at valuations. And then our last defense is that thankfully this slide has always been in your chart to say when we now start to talk about a 4-year view and a 5-year view where valuations start to hit 50%, we bring that into account. And that's pretty much, I think, why they've got a 25% in our risk weight. Let's look at the US dollar. A lot of the ideas I talked about would do even better if the dollar weakens or has got more room to weaken. Relative to developed markets, it has been weakening last year, which is the first stimulus that the US got. I mean, half of the earnings in the S&P 500 are overseas. So when the dollar weakens, they get an earnings boost of over 5%. The number is like what we've read. So 15%, add 5% currency, easily 20. So we can't negate that. The point, though, is that it looks like it's got a long way to go before it hits the flat line, which is the fair value, whether you're looking at it from a DM context or from an EM context. And that is also a great inflection that happened last year. So we got another bounce that we're hoping is going to turn on into expansion. What is the room for expansion? It's significant. Will it happen or not? We don't know. But if it happens, is it a big way to go? Absolutely. What is the middle ground? Somewhere here where my cursor is. So there's a middle ground to every story. We don't want it to get here, but if it gets to the middle, that's enough. That's another 10%, and it can make miracles in our regime-based asset allocation. So now you do know that when we are in a strong dollar cycle, we prefer not to have too much EM, and our base benchmark is 85.15. When we enter a weakening cycle, like we have where the dollar starts to weaken like it has, we shift to a dollar weakening benchmark, which is 70.30. Now, here is the part I can sort of like immediately say to you. We don't know if the dollar is going to remain weak this year, and we don't know if it's going to be weak next year. We do know that the long-term trend is weakening, the structural side. So this quarter, we're implementing a structural adjustment to our process from the 85.15 to the 70.30. So it's not a tactical, it's a structural. So it might look like we're overriding our tactical signals. We're not. This is a structural design into the philosophy to change the base benchmark when you enter a weakening cycle. The next question you're going to ask us is, T, you can clearly see that the dollar has been struggling to enter this weakening cycle. What if it rallies back? What are you going to do? Like, are you sure it won't? And I'm going to say, I don't know. Actually, it can rally back. Who knows? What I can tell you, however, is it would be so irresponsible of our team to move 85 to 15, sort of 85, 15 to 70, 30. That's a 15% reduction in DM. What if all of those stimulus things I was talking about happen now and the dollar strengthens like by 20%, having weakened by 15% last year? Then what? This is the part where we're gonna move gradually to reflect the structural trend of our process. So we're only moving in steps of 5%, not even the 7.5% I talked about earlier. So essentially, we're moving towards the 70/30, but this quarter, we're moving from 85/15 to 80/20. So this is steps of 5% per quarter. We look back at our data again in July. We do another deep dive into our house view. If it confirms, we go to 75/25. And then we do another deep dive in October. And if we're happy, we do the final one. So there's going to be a gradual shift, which is a structural design and not a tactical design. Now, here's the part where if you sort of move from a 85/15 to a 70/30, you sort of end up with this benchmark where my cursor is. And then you would know that we prefer for this 65, we prefer in this developed market part for about half of it to be market beta, 1/4 to be enhanced beta. And then we use 15% for active managers for clients who want to see an active name in there. Otherwise, all of this should go to market beta. And then we have a thematic block. A thematic block is earnings which are starting to come through, but there's a lot of evidence that there's a significant supply deficit. So those earnings can remain explosive for longer than any traditional valuation metric can comprehend. So now we're seeing a demand for commodities coming out of the AI story and many other reasons. And all of a sudden, everyone wants gold for central reserve diversification, platinum for all the other reasons, copper, lithium, natural gas for the cooling in those systems. But we know that commodities have been in a downturn for 20 years. So those earnings are dead. No one has been investing in supply. So that means the supply deficiency of commodities might prevail until they start to restore volumes. This is a thematic block where the earnings are abnormal, difficult to comprehend, and you don't want to guess on that. We put them into that. So you would know that for the longest time, we had a 5% exposure to global commodities, and then 5%, I think, to the technology story through the NASDAQ or a growth manager. And we're now saying if Trump wants to release 400 billion through tax rebates in 3 months, and then there was already another 400 billion of capex last year, and another on the previous year, and another on the previous year. There's going to be a tariff check. The Fed might cut rates. There's other aspects of deregulation. There is a very high chance that the US consumer comes back like a raging bull, and you don't want to stand in front of a raging bull. So we're bringing in a little bit of that S&P 500 into this thematic block. So first of all, we will reduce the DM from 85 to 80. And then in the 80 that remains, we will then allocate to these specific thematic blocks, and then the rest is as invested. So if I kind of address the US, where we respect the beta code to reduce it first, and then within the DM that remains, we rearrange the S&P 500. So as it stands, you've got a good sense of how global small caps are coming into your life. You know how the S&P is coming into your life. You sort of know how South Africa is coming into your life. But let's go on with other decisions. You sort of talked about what's going to happen with Japan. And we thought, okay, cool. Within the DM block that remains, let's also take this amount. So we're going to have 5% in gold, which we always had, 5% in the Russell 2000, which we always had, 5% in Japan, I think, which we sort of always had. And then that addresses the Japan story. So we're not going to increase exposure. We're going to retain exposure. You will know for a balanced fund, your strategic asset allocation to global equities is 20. If you say 20% multiplied by 5, you get a 1% extra allocation to gold. So we want about 2.5 standalone gold in a balanced fund. And then you see our recommendation say 3.5. It's because you're getting another 1% from your global equity carve out. 20% of 5 is 1%. Most of you introduced a 1% Russell 2000 ETF. 20% of Japan, again, an ETF of that. And then 20% of this is a 6% DM ETF. Now I'm breaking it down into a Reg 28 balanced fund because it's coming from this global equity carve out. which is slowly moving to 70-30, but not in a fast way. So we always capture the middle ground of the extreme narratives. When a bounce happens, I want to give you an example of 2000 and like maybe like where my cursor is, that's 92, 94 as a very good example, or 2006 sort of as another example. Your earnings are super depressed and they're starting to recover, but the market moves ahead of that because it can see a recovery in earnings followed by an expansion. So in the very first year or two, your valuations become expensive. So this is why I was saying you may look at us and say, why are you doing all of these things in an expensive market? And one way we can see that things are expensive is if you look at the S&P 500's equity risk premium, where we take the earnings yield of the S&P 500 and we subtract from it the yield of the bond. The number is very low. But what if those earnings improve? Then that increases, and then you have that up. This all of a sudden looks like it's fair value. So we've got negative value if you use the equity risk premium, which will stay negative if earnings don't come through, in which case we are wrong, but which can normalize if those earnings come through. So essentially, you almost have to look at the valuations in the context of your view on earnings, and then you can make the right call. The other side of this is there's no way this number is not going to be negative because bonds sold off in 2022 and they haven't recovered yet. So those bond yields are too high. They may not go down anytime soon because your real growth is strong. They may also not like worsen further because inflation is coming under control. So you can use a bond argument or an earnings argument, but either way, it kind of gives you a sense that the only way you're going to add equity is when the risk premium is negative across geographical regions is if you've got a strong view of the inflection of earnings and the consecutive expansion. So I'm flipping through a lot of slides, going through again the four geographical regions, and it's not a secret. The equity risk premium is very discouraging, and why are we even going on becoming more aggressive? The underlying thesis is the earnings bounce and the earnings expansion that we're expecting. I'm going to skip familiar slides so that I make up on my time. So if we then say, okay, great. When you look at the Apex Investments Consulting, how many earnings cycle is the team seeing where there's been an inflection that is starting to get into a bounce? Global growth tax regime. This is a function of the lower the oil price, the better. The weaker the US dollar, the better. The lower the credit spreads are, the better. The higher financial conditions are or markets are, the better. And then the lower bond yields are better. This is to a very young regime because you can pretty much, I think, say like as the equity market broadens out in the world, DM starting to come through like last year, financial conditions become better. As our rates are cut further, that becomes better. If credit spreads remain low without a recession, that's likely happening. So this is pretty much still quite young. So you can say it's got about 1 to 3 years to go. Gold, we don't even know what the time is. It appears quite young. Duration risk, South African bonds rallied quite aggressively. The normal return from a bond is CPI plus 2. Currently, you're getting CPI plus 5. So this is still quite young. USD cycle, I'm not going to go through. You saw the picture already. Global commodities, they just inflected, so you can't say they're old. Technology in EM is catching up. In GM, everyone has their own view around AI, but the one central view is that it appears that it's only beginning. South Africa's terms of trade was because of the rally in gold and platinum last year. You can say that it's young. Chinese consumer cycle, they're only starting to wake up now after COVID being locked down 3 times. They're so mad they're not spending. Now they believe they're not going to be locked in again. They're starting to believe it might be true. So again, this is still very young. The value small mid-cap cycle, we all know the value managers only started really breathing recently, so it's quite young. Real estate, South Africa ahead of the curve, but DM not. Chinese real estate only starting to wake up now and will know in March. So we pretty much have a lot of earning cycles which are matching our regime, and hence this excitement that you're picking up and the energy that I might be able to sort of be to release. So when we bring it back into a picture, how does that look like? We have put DM and EM AI plays here because there is a very high chance that they're in the very early stage of their growth. We have put DM equities in general here because they're definitely not euphoric, and the Fed still wants to cut rates. Fiscal policy, President Trump is spending like no man's business. The companies that have got a lot of cash are spending like there's no man's business. So it's very difficult to say that there's not enough being done to robustify the earnings of DM equity. So it's kind of moved here. So you can see like it's a bit of a risk on trade. And I think all the questions I was asking you, like by now, you've got very good answers. So where is Japan? We've got it here. Where are those small caps? I think you've got them somewhere here. I can't sort of see very quickly. Where is South African properties here? Where's God here? And the only thing that we're a little bit afraid of is dollar cash, which is a big driver of DM cash and is a big driver of credit because there's no spreads here. So it's pretty much the US dollar that we think is going to weakening. And the beneficiary in the translation of that would be the asset classes in this particular area. So it's a little bit of a shift in our positioning. I'm going to now rush through this part, and this part. I don't want to spend a lot of time except to leave you with one observation. You are not getting anything in the extremities of -5 plus underweight when you look at our scores. Everything is close to the neutral if you look at it from a regional perspective. Everything is close to the neutral if you look at it from an asset class perspective. Everything is close to the neutral when you look at it from an investment style. And if I touch on the things that are negative, US small caps, when those earnings of 67 come in as 30, do you think they'll remain here? We don't really think so. Resources, we don't think so. US equities, if that AI and all of those stories, we don't think so. So we've got a bit of a marginal valuation push on the negative side, but the expansion side, I think, sort of like challenges you to think very carefully about position sizing. We still like duration risk, otherwise, we would not have been talking about further monetary policy support. So there again, we're still aggressive, and I'm rushing through the slides because I really don't have anything new to say. So now the next part of the story is what when you have a philosophy and process, you must always have an independent strategist whose views you compare to your signals. So we have got two, Alpha and Macro and the BCA. So let's look at what the BCA is thinking about. They're currently neutral. And then they say this neutral is based on their theme for 2026, which they call the year of revelation. The year of revelation means this is the year where they think they're going to finally understand the AI story. Is it too old? Is it too young? Currently, they're saying they don't want to make a bet on it because it can be either. So they've got a middle ground of saying we're going to participate because we don't have enough information to discredit it. However, in the 12 months, if we see evidence that it's a farce, we'll go underweight. And if the labor market weakens more than we expect, we'll go underweight. But if it doesn't, by June, would have changed this 12-month view to overweight. So this is the first part. Now, the question I asked you, are we going to rush to downweight the USA with all of this? Maybe not, but let's keep on having the conversation. They're neutral on bonds, but the longer term view is to be overweight. Neutral on cash with the longer term view to be overweight. We prefer bonds to cash or unconstrained fixed income managers to cash or multi-asset income managers to cash. So you can kind of almost say from this particular angles, we are aligned to our external criticism, if that's the right way to think about it. The USA, they were neutral, but on the 22nd of January, they took away about 3% from the USA. So if it is 70% in the benchmark, they've cut it down to 67, which our move from this 85-15 to the 70-30 would have done anyway. And they've taken this to Europe, which means that they're very happy with cyclical ideas. And we also are, otherwise wouldn't be moving from 85-15 to 70-30. So from that particular angle, we are similar. UK, they don't like it in the near quarter. Canada and Australia neutral, and then Japan and EM, they're overweight. And there we start to have alignment because you already saw that 5% in Japan and the slight increase in EM are pretty much aligned with our external view. In terms of government, overweight government bonds, we still are, even though we're taking a little bit and giving it to South African equities on the global side, but on the local, we're keeping that. Duration risk overweight, so we are quite aligned. Inflation linkers, at least neutral, we are quite aligned. Let's keep on moving with the dollar. We are aligned. They are brave. They've given a short-term view where they're underweight, long-term view, they're underweight. We are not sure on the short term, but we're positioning for a longer-term weakness with that benchmark change. So we are quite aligned. We don't like the sterling. It looks very expensive. We love the yen, hence the Japanese equity exposure as well. and we think the Chinese yuan and Chinese equities are cheap. So here we are quite aligned with our external critique, which is the BCA. And then if we look at commodities, we're quite aligned. You know, we like resources. We're talking about the inflection point. So we're pretty much similar. And gold, we are quite similar, although we're taking profits very aggressively. Yeah, we did that twice last year, and the profits we've taken out of gold are at least 2.5% of your portfolio. So we doubled it up actually. And I think twice that we took profits, it was the right call to make, and it still came back to levels before we took profits. Our second critique, Alpine Macro. Equities, they're overweight. We're not so different. That 3% coming to South African equities tips us into overweight. Bonds, we are neutral. Yes, we've reduced the global side, but on the local side, we are overweight. Cash, we're pretty much aligned. US neutral. They don't want to take a bet with all the great stories I talked to you about. Europe, they're not so convinced that Europe will rally until the Chinese consumer is back into buying those expensive, like the luxury items. Emerging markets, they're overweight. I'm going to skip a lot of things. The key point here is we're trying to see if there's anything we are trying to do that our two more experienced external strategists would be doing differently. At this point in time, without taking a lot of time, we are quite aligned. So where does that leave us? It leaves us in a state where when we're looking at the strategy, we're comparing constructing portfolios with balanced fund strategies. We're at a recession risk block of about 5 to 7%. Because the recession risk signal is now unwound, we are unwinding that. And we're saying rather take it to equities or property locally. But we also know that the yields here are very high at CPI plus 5. So some clients will say, I would rather have this 5%, which is more guaranteed than that of your earnings inflection, earnings bounce, earnings expansion, like story you keep throwing in my face. So let me keep something simple. We're very happy with that. So here you either keep it or just rather bring it to equities or property. And then the 7.5% exposure to China we're keeping. But we all know that the finer details of the 15th five-year plan you're going to get in March. And they're focusing on three things, boosting domestic demand, deepening technological independence, and food security. And all of those things may need fiscal policy support, which I think is going to sustain the Chinese bull market that we confirmed as official in July last year. And then for your specialist, so for this particular funds, you know that previously we had a lot of underweights for the different styles. So growth would be a growth manager like ABEX Balanced Fund. Quality will be something like the 91 Opportunity Fund. Value will be something like Coronation's Balanced Fund. Momentum is something like the 91 Managed Fund. Market beta is something like the Net Group Investments Core Guided, etc., etc. So we're neutral, equal weight of 12.5. We're keeping the Chinese exposure. And then this defensive block, if you want to keep it, great. If you don't want to, saying go and buy passive SA equities and just ride, I think the recovery we have seen. For specialist building block portfolios, I'm going to summarize our main calls. Real yields are still very elevated, 5-year plus, at least CPI plus 5 for South Africa, CPI plus 2 for DM. The average in South Africa should be CPI plus 1.5 to 2, so you're getting 3% extra. And then in the DM space, it's typically CPI plus 0 to 1, so you're getting 1% extra. So we're saying when you look at your specialist building block, please try and have at least a neutral weight to the SAA. If you do go overweight, don't buy more than 2.5%. And then if you look at the global AI theme, to be honest with you, the demonstration there is that if it works out, the earnings profile of these things is exponential. I mean, how do you explain an Alphabet's of order book going up by 240% in 3 months? So it's got a very exponential nature to it. When a chip's efficiency increases, it's increasing exponentially. Once a new chip comes in, the effect on power demand is exponential. When there's cost cuttings, they're exponential. So it's kind of not a linear story which your brain can wrap around very fast. And because of that, through our thematic block, we sort of have these two editions of the S&P and NASDAQ after like the DM EM transitioning. So I really do hope you're seeing there's a lot of things moving, but it's all really process informed. So what I should have maybe had, or what we should have had, is number 3 coming first and then number 2 after, because the change in 2 comes after we adjust our portfolios for a weakening dollar. So we first downweight DM, and within what remains, we position for the S&P and NASDAQ to reflect that we don't understand the AI story, either constructively or negatively. The China story, we're keeping our exposure. You've held this for a while. Commodities, we've held them for a while, and we're keeping this. I'm not really going through a lot of the details because in my empty of the story, I did go into a lot more details in intro than I should have, which I think obviously makes my life easy now because now I'm running to catch my time. And then if you look at point number six, need I explain the small cap story again? I showed you the inflection, the earnings that are expected to come through. For the USA, I think I overdid the policy stimulus that has been happening. And then for South Africa, I think the story is great. New inflation target, room for rate cuts. A strong rand means inflation that is imported is under better control. So even more room to cut rates. The Fed still having a cut rate slant, great. Reforms of Transnet, great. ESCO making a profit for the first time, great. So SA Inc. story, great. Gold likely to go I mean, there's a lot of slides you can bring in that will ultimately come into SA Inc. small mid cap. And again, there we are sort of retaining exposure, and we've given you options to do that. Otherwise, you can just go in a passive way. Gold is difficult for us because the people that are buying it are price insensitive. If central banks want to allocate less to US dollars going forward and allocate more to gold and maybe the euro and the Chinese yuan, that means that the support is because of someone who doesn't think about it in a valuation mindset. They think about it from a geopolitical power perspective. We don't want to gamble with that, and we're keeping our exposure of 2.5 without the 1% tip off that comes from global equity I showed you earlier, and this becomes the range. But please, very aggressive profit taking. We took profits twice last year. We're probably going to do that in a couple of weeks from now, and we'll send you an email to do so. And then we just keep on making that so that the position size does not become too much. The recession's risk score improvement, you sort of saw what we did there, so I'm not going to really say anything else to that. What I'm going to finish off is the equity risk premia are negative, meaning that currently bonds are a better place to park your money than equities unless you're expecting a strong earnings recovery, which we are. This automatically means that as those earnings come through and they are priced in, the next big call to make is to then take profits from equity and go back to bonds. So our next big call is going to be the profit taking out of the growth assets we've introduced now, where we start to take them back to DM bonds, take them back to DM ILBs, take them back to global property, and bring some to South African cash because we might have exhausted the bond duration risk. So we are not yet implementing number 10, but we're positioning you to say, if these calls work strongly, don't be surprised when we start buying what you might consider boring assets because we need to take profits if the calls work. But that's not for this quarter, maybe for next quarter, maybe not even for 2026. But certainly, if you say to me, what next? Because you've done all those things, it's certainly going to be point number 10. How does this look like in a portfolio? Your South African equities are now going from neutral to an overweight of maximum 3%. Property South Africa, we're keeping at your neutral, whatever your SAA is. IOBs, we're very happy for you to be neutral, but you can buy an extra 2.5 if you want to, but not more than that. Nominal bonds, we're happy for you to stay neutral, but whatever you keep, make sure the duration risk is super high. And if you want to go overweight, don't do it above 2.5. We just don't think it's worth it for today's environment. You're obviously going to fund that by reducing your cash. You can also find it by reducing your emerging developed markets. And then revenue reduced DM by 5%, and that goes into EM by 5%. We split that up where half goes to EM, half goes to China, and that explains that part. China, why does it go to that extra 5%? Remember, it had that superior score when I started the meeting. So that's how you bring in that extra 2.5 if you want to. If you don't want, just keep it neutral. But there's room because of that geographical split I sort of spoke earlier. DM real estate. We just want 1.5 that we can take to SA equities. DM IOBs, we also just want 1.5. If you don't want the 1.5 to come from real estate, you can take it from nominals and ILBs and you get your 3%. You can also take it from credit. You can take it from any of the cash, and then your portfolio, voila, is done. Global equity gold, 2.5 to 3 with active profit taking. And that's exactly how it's going to look like on the global side. And then if we sort of say like, how do we finish this? And the gist of my message, which I can see I've taken 10 extra minutes, is that this is how we are positioning your portfolios for this quarter. And I've kind of gone through the reasons. I'm going to take you through how the strategy performed last year. And that's going to take me 5 minutes, which is going to bring me to 1 o'clock. And I can promise you from 1 o'clock to 1:30, I'm now repeating everything I've said with different slides. You may not pick it up, but I'm now pressing replay, and I'll tell you as soon as I press the replay button on my cell phone. So in terms of the 1 year performance of asset classes, I think gold did very well. So we were handsomely rewarded. We took a very aggressive bet to say we're not going to buy the ETF. We want the miners and the stocks, and they gave us the gearing we expected, almost like 3 times better in performance. And this gave us the ability to take profits twice. So we essentially more than doubled our exposure, which is why the profits taken are equivalent to the position size at the outset of the year. So there, I think we've done really, really well. South African equities, we need not say, were neutral to overweight that paid off. Property neutral to overweight that paid off. And then if we then look at what hasn't worked, most of this is the recession hedge asset classes. And you wouldn't expect recession asset classes to do well in a pro-growth year. And us reducing a little bit of them into weakness, most of this weakness, to be honest with you, is representing rand strength more than losses in these asset classes, because in dollars they did well. And because of that, we're sort of adding that to SA equity because of the story I've sort of given you. We're not closing, we're just reducing a little bit there. Commodities, you can see that they have not yet turned around the way we want to. They started the year with a bang, but for the whole of 2025, not quite the case. And obviously, if you had used 3 months numbers for this, you would see they've started to do well. You would know that we are still neutral except of the small cap. And if you look at the local side, not big differentiation. It is there, but it's not worth sweating. If you had been equal weighted or the local multi-factor, you'd have done okay. On the global side, the fact that we're underweight the DM and neutral to overweight EM, China, and South Africa, you can see that it has also paid off. So it's been a great year for us, all else equal. It's not a surprise that if you think about this from an ASISA category, all the global mandates did badly and the local ones did well in Rand. And the strong Rand with Rand strength being one of the reasons for the weak performance here. It kind of like I think helps us to see that if this was the way we were positioned for the whole of last year, at least 75% of our calls were well rewarded. What I want to leave you with is because our recession risk is now out and we've seen multi angles of stimulus going into the USA, it's becoming tricky for us to put DM equity, global tech, DM growth, DM quality in this bucket. So you'll see that we've removed it from this bucket and it's come here where you've got DM equities. We don't know which ones of these middle grass it is, but it's difficult to call that euphoric given everything that is going on. And then it's difficult for us now to continue to like position against global technology as if we understand the AI story, even though everyone we speak to says it looks like it's in its early innings. So we've removed it from this last part and it's coming sort of here, but you sort of saw how it just sits in our thematic block in the global equity and everything else we have not changed. So this is pretty much how we are approaching 2026. So obviously, when we had the alphabet results, that the market is angry that they are spending more, we're very anxious to say, oh my God, we're about to tell clients we are neutral on that and it's being punished. And then the next morning, it rallied 7%, having lost 3%. And like there's all the software stocks selling out. But I think the key message I want to leave you is when we were doing this research, we'd spent 2 weeks exploring every of those ideas. We did not have our basis point as a 1 week development or an earnings season announcement. We kind of had a longer term view. So despite all the noise in the markets now, the team is confident that for 2026, this is how we want to start and we'll review it on an ongoing basis. So now I'm going to press replay. If I look at pillar one and start to say what I said in a different language, which is our pillars, we get to a point where if you look at economic growth, which is all these four factors from real GDP, nominal GDP, or industrial production, into PMI numbers, which by the way, the early ones are looking really fantastic, and I'll show you later on. And if you look at inflation from all these different dimensions, you kind of get to a score when if you put it into a risk rating, every area we look at has got a score of -1. And then and here I am with this very beautiful story. And then if you sort of break it down and say what's going on, you realize that it's because the geopolitical risk score is sitting at -3. So if you kind of remove this and you go back here, you might see that most of these regions are reflecting a profile of stability or fair value, and they've been sitting there pretty much for almost like 18 months, or like six consecutive quarters if I've got my numbers working correctly. And we also want to leave you with a very powerful insight that was made by, I think, 361 yesterday to say, don't forget that if it was not for geopolitical risk, we would not have the capex we are enjoying. And you say to us, what does that mean? The AI story, really, to be honest with you, is a story between China and the USA, and it's an existential race where they're going to spend until one person wins. So it's a price insensitive kind of story where it's about supremacy. So would we have all these data center rollouts? Would we have Alphabet spending more and more if it was not a geopolitical issue? I don't really think so. Would Europe wake up and realize they cannot depend on USA to save them and start going into the aerospace and shipbuilding and all the defense that they want to spend? Had it not been for Trump annoying them? We don't think so because we know they did fiscal austerity for 15 years. They don't like to spend those guys. So this geopolitical risk, as much as you can look at it as -3, a lot of the things that are stimulating growth, really, to be very honest with you, are coming out of a geopolitical tension that forces people to spend and stand on their own. So from that particular regard, you can kind of get a sense where this -1, you kind of need to realize that if you don't have the score of -3, it's better. But you also need to know that a lot of the things we're bragging about have at the center of them the foundation to not be vulnerable to the US on a geopolitical risk front. So all in all, this is a weird geopolitical risk score whose consequences are great fiscal policy spending, but the disturbance of uncertainty is negative. So you kind of need to take it again with a middle ground. And whatever that middle ground is, we don't know what it is for you. But for us, when we look at data, we're seeing that as much as President Trump has embarrassed presidents, has humiliated them, has said all kinds of crazy things, as much as he has like done the taco policy, he's kind of got people to think to say, what do we do for our own economies? And the result of that is aggressive fiscal stimulus. And if you look at this PMI numbers and growth momentum, every region now has shifted from below 50 to above 50, another expansion. So below 50 is contraction, above 50, a bounce into expansion. So the macro pillar is confirming everything that I've been saying. And then if you look at the IMF, I'm not going to take you through the numbers on a one-on-one basis, but again, those numbers are looking great. Let's just maybe touch on South Africa. You've got people used to 0.5 real growth for almost like 10, if not 15 years. All of a sudden, that almost trebles to 1.3. There is no way that won't fit through the economy gradually if it's sustained, and you kind of keep that. So this growth inflection in SA, which might become even better if the commodity cycle wakes up, is one which we sort of are not underplaying. And I think that kind of gives you a sense of like why South Africa also got an increase in exposure over together with Japan, China, and EM. Then if you look at your macro regime, I already spoke about how it was -1 for a long time and is now moved into almost zero, which is released at 3%. So we're not going to repeat that lest I bore you. And we also talked about how this works. But I think what I thought we would do is let's just have a numerical game here. First of all, may you kindly remember that for the Mag 7 stocks, we're looking at about 35% focused earnings. For the rest of the economy, let's just use the number 15. Like I know it's not exactly 15, but maybe try keep that. And then if we go to commodities, please do remember that for 20 consecutive years, they've just been going to the dogs. No investment is happening. Now everyone wants them for data centers and everything. So the inflection from here is going to be caused by the supply deficiency caused by years and years of burning cash without making any money. And then if you look at South Africa and you look at our resources sector, there's an expectation, if you use the numbers by 91, Bank of America, Merrill Lynch, and the estimates on Bloomberg, The average of those across analysts is resources earnings coming in at 68% this year, 90% mostly coming from the precious metals. And then if you go down this number, telecoms, you're getting about 50%, industrials, 20% in general. And if you look at the final number, we've got 28% of earnings to come through in South Africa. But let's just reduce that to 15 so that you keep the number 15 in your mind for a reason that you'll see later on. So we're sort of in a regime where we're expecting earnings to grow, but let's just say every sector grows by 15. You saw that for some it's 90, for some it's 68, for some it's 28, for some it's 35, but let's just use 15 for the sake of our house view. And let's assume there's only going to be 50 basis points of rate cuts this year and next year, and then the 100 basis points is done. 0 is the beginning of 2026 and 1 is December. If you have 15% growth from an earnings of 100, it comes down to 115. And then if you keep it up, it goes to 130 and it finishes off, almost doubles in only 4 years, which means by the year 5, you've doubled your earnings. If if interest rates are cut, let's say they start at 10 and then we're 50 this year, that's 9.59. I think you get the gist. This is the macro regime and the business cycle we have. Earnings growth, monetary policy support. And now if you use the long-term dividend discount model, the price is equal to E over I. If you just want to keep it simple, 100 divided by 10%, that will be like the price. And if you look at that, if you start off with a price of 1,000 and the rate is 10%, the value is 1,000, and 1 year later in December it grows to 1.2. If you translate that to performance, that's 21%. Now remember, the moment we're talking about 30% for AI, you double this number. The moment we're talking about 28% for South Africa, which is so, you double this number. Last year, SA did 41%. If it comes through 28% earnings growth, it can do another 41. If you make it 3 times to 67% earnings, which is what we saw for the small caps, this number becomes 60%. We're trying to just give you a sense of how a regime of earnings growth and monetary policy support is multiplicative on performance. And I think from that perspective, you kind of get a sense of why we added 3% to risk. We didn't add 10, just 3%, and then we rearranged the remaining risk we had. This is just 91 saying we are now in a Goldilocks regime. A Goldilocks regime is higher growth, the higher growth regime quadrant and the lower inflation quadrant, which causes monetary policy support. And you can see there's quite a lot of areas sitting here. So we are again confirmed if you bring in an external critique to your views. On currency, I think we sort of already talked about, we've got a long way to go in terms of dollar weakness. So the first part of charts is the US dollar. The first two is the dollar relative to all developed market currencies using a long-term measure like PEE. You get a very good score of 2, meaning that we've got good runway to get back to 0. And then if you use the real effective exchange rate, again, 2. And then if you use the dollar versus emerging market currencies, extremely cheap. So there's quite a lot of runway, I think is the message we want to leave you with as far as the US dollar is concerned. And as far as South Africa is concerned, the score is 0. If you look at South Africa versus DM, meaning that we're kind of now indifferent. And if you use the REA, it's saying there's still a little bit of risk, which means that we are pro-SA. We did that by increasing South Africa's weight. And then if you look at South Africa versus emerging market currencies, it's fair value. This is a way of saying you can keep money in South Africa and take it to EM if there's no issue to worry about as far as currency risk is concerned. Now, let's come back to this DM conversation and say just how much does 2 mean for DM currencies? Just how much does 3 mean for EM currencies? If you go to the next slide, just how much does 2 mean for DM currencies? If it is relative to Japan, it means 72% upside. If it is relative to Canada, it means 27% upside. But if you just take the average, you're looking at another 18%. So it did 10% weakness last year. It can do another 10% this year and another 10% next year if you just divide this linearly. But we all know that markets don't work in such a simple fashion. And then the next question is, how much exactly are we talking about when you say 3? If you move to emerging market currencies for South Africa, it means the rand can gain another 23%. You saw that it gained 12% last year, which means it can still do another 12% this year. another 12% next year before it is considered expensive based on how we look at the world. This means the dollar can still weaken by 62% versus the Chinese yuan, 31% versus the Brazilian real, 31% versus the South Korea, about 93% versus the Malaysian ringgit. Like these numbers may not work out, but on average, the dollar can still weaken another 18% versus DM and another 30 pretty much versus EM. And for the rand, what does that picture mean? The rand is kind of saying if you buy too much European equities, you must be ready to give 11% to the rand. Buy too much UK equities, you must be ready to lose 23% to the sterling. Buy Japan, you can get another 44% on the currency side. Get too much US, just be ready to lose another 23. So the story is not yet a good one in terms of developed markets, which is why we took those DM bonds and we brought them to South African equities because we can't see a scenario where DM nominals and ALBs are going to give you 23% to offset the currency, and that explains the movement. And then in terms of emerging markets, if you buy Chinese equities, the rand can weaken and give you 24% on Chinese assets. It can give you 17% on Brazilian assets. It can give you 15% on South Korean assets. And these are index heavyweights. So I would think that there's still opportunity there, all else equal. Valuations, I really don't want to talk about them because, yeah, like if you have prices moving ahead of the earnings recovery, everything is going to look expensive. And if those earnings come through, you're going to regret being underweight because of valuations. In the short term, you don't want to put too much weight there. Thankfully for us, one quarter comes from asset class valuations and another quarter from currency valuations. So we're certainly not putting too much. But the picture is where you start to see a couple of minus twos, only valuations, right, before you think about the earnings. If you look at the DM side, you start to get extreme. So it's a really mixed bag, cheap, expensive, very expensive, and all of that. So I'm really not going to spend a lot of time there because the messaging is not going to change from what we said last quarter. It's no longer a dripping wrist when markets were very cheap because recession signals were very high. Now that the recession risk is gone and markets have breathed a relief of the soft landing. Remember, it was just 2024 December when we are talking about soft landing last year and it happened and the markets have breathed a sigh of relief. Now the earnings need to come through and that's essentially where we are. So valuations, very discouraging. You need to put your earnings growth hat on, then it kind of starts to make sense. Now I'm going for the close. If we look at geographical asset allocation, you remember very well, I took you through this picture. And you remember very well, I gave you a hint of where we want to add risk and where is it going to come from? It's going to come from DM and USA, and it's likely going to go into Japan, EM, China, and South Africa. I don't want to go through that whole story again because the earnings behind that is a bigger support. The only part I want to give you a sense of how does Apex get to say, take 5% from a passive DM block like the Satrix Miski World and give Satrix Miski Japan 5. Like, where does that come from? And then I think if you sort of like try to get where that comes from, this is how we do it. In the regional house view, everything for us is interpreted in a relative context. So if you look at this particular chart, we've got the PE for the Nikkei and the PE for the Miski World. And then if you then say, what is the color coordination? Miski World is the blue line. And this broken blue line is the fair value range for this PE for developed market equities. Japan is the orange line. And the broken orange line is the fair value range for the Nikkei. So you would know if the PE is above average, it means it's expensive. And if the PE is below average, it is cheap. So on an absolute basis, you can see that developed markets are more expensive than Japanese equities because they are way above their 1 sigma level. Now, if you come back to this chart, you're going to get the same answer. On an absolute level, US score is much higher than the Japanese score. The US score is minus 1.55 or minus 1.32. And Japan is only minus 0.36. So you kind of know what the picture looks like in an absolute context. So that is not debatable, right? And we've sort of said, okay, this looks like Japan is cheaper. But what if you do a relative chart where you actually take the PEs as a ratio and you look at the range? Generally, when the line is above the orange line, it would mean that developed market index is better than the Nikkei. And when it is lower, it means that Japan is cheaper. The Nikkei is cheaper than Misky World. And then if you look at that, it would give you an extremely cheap signal, which means that you can take 15% away from a DM index and give it to Japan and still call that your DM view again. There is no way we're taking 15% from a US dominated index for Japan, given all the things that I say can work out for the US this year. But there's also no way we're doing nothing about it. So we thought the number is actually 5 and not 15. And that explains that how that 5% came in. I don't have to take you through all those charts for the forward PE, for the price to book, for the dividend yield, for the trailing earnings, for the ROE, because I'm really just going to cause like a 200 and 250 slide deck, but I can compress all of that information into one visual. When you compare the Satrix Miscellaneous Index to other areas, the picture you get is the scores are at least, the lowest is this one, are at least 1.5 better than keeping in a DM index. 1.5 is about 7 now. So it means you're better off taking a little bit from the index and give it to China, take a little bit and give it to EM, take a little bit and give it to Europe, take a little bit to Japan, take a little bit to South Africa, a little bit to UK. And that's sort of how we got to our story of giving the number one ranked here, which is Japan, that particular score. And then the second one ranked is South Africa. It kind of gets the score. And then we're not sort of going any further, I think, than the third ranking. So from a relative context, that's where those small little adjustments come from. So I've already given you a sense of how do we get to the answer of small caps and Japan. We take it out of the DM passive so that instead of so if you take this DM passive of 50 and you give the 5% to gold, which we hold for geopolitical risk, you're left with 45. And then if you take from this 45, if you take 5% and you sponsor to small cap, you're left with 40. If you sponsor Japan, another 5, you are left with 30, I think. And then that is where you get your DM equities of 30. And then if you add back 30 plus 5 plus 5 plus 5, you get to this answer. So I think you sort of get a gist how we do that. And where do we get the boldness to do that? We lean into the geographical house view. You see it's got charts which look like this across the 80 slides in there, I think. And then this final visual says you can afford to tilt a little bit to rearrange the whatever remains as DM equities. Now let's flip the script and let's do this from a South African context. The blue line is the Misky World Index. The broken blue line is the average. And then obviously you can see that Misky World is very expensive. South Africa is the orange line. It's kind of borderline fair value. In a relative context, you can see that the DM side is inferior. This means that it's going to be very difficult for us to take money from South Africa to DM now. But the other direction would make sense. Fortunately for us, we chose to take from DM bonds and DM equities again because the benchmark shift already reduced DM equities. If you bring it into a visual, you get a sense where this is saying if you're really going to take money out of South Africa, the only person that really, really deserves it is China. The rest, you need to really be sure what you're doing. And I think that explains that extra 2.5 you saw us taking to China. It kind of really comes from this particular chart. And then if you go into investment styles, it's the same picture, 4 factors, and then you bring in the 4 factors, you get a final score in the orange. And then if you want to look at what the orange looks like in a much clearer format, it's O minus ones on the DM side and a basket, mostly 0 on the South Africa side. This is why we're not taking any style bets, except of a little bit of a dig in to small caps for a reason that I've already alluded to much earlier. Manager selection, there's no way we're going to have real yields elevated as the number one call and not talk about ILB managers. Take your pick. Often the argument is that IOBs have got such high duration risk. Can you not give that to us with much better duration risk? I think the Granite Active Bond Fund, because it mixes both, can help you with that. The Pricing Flexible Bond Fund can help you with that. But if you want pure ILBs with half duration risk, the new Ford Inflation Linked Income Fund with a duration, I think a real yield of almost 5, but half of the duration risk can help you with that. Or just keep it simple because the IOB index is what was in your SAA modeling. You didn't have this thing when you're doing your SAA. So why now? Then you can have Stanlib and Momentum and the iShares tips. Value managers, the same suspects. They're coming through quite nicely. We see strong performance from Contrarius recently, strong from Orbis, strong from Ranmore. T Roy Price being the last one to come in, also really doing really well. Small mid caps, if you sort of say to us, how do we execute? We've got this list. I'm not really going to take you through all the detail because you will have this in your inbox on Monday. And then on the global small mid cap story, you also know what that story is. So pretty much not much has changed in terms of what we would perceive to be topical exposures. Now I'm going to go for the grand finale in 10 minutes. I think I'll make it where we're now taking every single asset class and we're bringing it into the four-factor approach. And then we're saying, what is the answer? So this is SA equities, SA property, SA law duration. I know you can't see these numbers. I know them because we've been doing a deep dive for 3 weeks. I know them by heart. So let me spare you that pain and like maybe just go into how that translates. And when you get our visual GIS, it's going to have very large clocks where you don't have to look at the numbers. You kind of just look at where the score is. I think that's going to be very useful. But we come back to the very same slide that I sort of closed off as. Please just give me 1 second. Where we've kind of made all those adjustments where the AI story is sort of coming here, but it's only 5% in a standalone global equity portfolio. In a balanced fund, is 20% times that five. You only bring in 1%. So it's not like we're going crazy on that. Please, I think, give us that. And I think if you also look at this, we're still running, although the conviction has grown higher, the strategy is still very, very diversified. So hopefully you also take some comfort out of that. And then if we come on to recommendations, I'm not going to really go through this except to say, if you remember this last quarter, maybe we should have had a previous quarter and current quarter slide to make this clearer. We had a bit of underweights here because the recession risk score was still quite high. Now that it's gone, all the balance managers are in orange, but we sort of have room to buy that into passive South African equities as well as passive South African property. But where you come to us and say, look, CPI plus 5 is better for me than what you want me to do, you can keep it here. And then the Chinese exposure, that sort of stays at 7.5. And in March, we're going to know exactly how the 15 5-year plan is going to play out. And then we'll take it up to 10%. So we're kind of waiting and we've been waiting for a while. And then if you go into the specialist building block, I'm going to sort of show you it's informed by these 10 stories. Remember, I said I'm in replay mode. So this is, shouldn't surprise you. I'm not really going to go through any of this, but essentially, if there's any slide, I think you can keep it's these 10 key views, which then translates into your portfolio this way. So South African equities, that 3% that came from recession risk assets comes here. And then the overweight in IOBs and nominals is being funded by South African low duration, a bit of the global cash. And then EM equities, they get that 2.5 because of the benchmark change. It's a structural design, not a tactical design. The extra 2.5 in China, if you remember, like I think where that came from. And then gold, very aggressive profit taking. So this is what I think the 8-member investment committee at Apex, sorry, it's actually 9-member committee, has said that when they bring all of their views together after a 3-week deep dive of every one of these ideas, this is how we want to start the year. And we're sort of going to run with this. And where we need to sharpen conviction, we are going to. Where we need to like reduce conviction, we're going to. But at least for the coming 3 months, this is sort of how we want to position your portfolios. We obviously don't leave these signals unattended for 3 months. There's a lot of webcasts by BCA, Alpine Macro, Absolute Return Strategies. The managers like are bombarding us with stuff. BCI conferences coming up. So we've got so many touch points to continue to check if we believe, if we know we're doing what we're doing. And for now, we're very, very happy with this type of positioning. On the global side, it is obviously going to look the same. And this is pretty much where we're getting our information from. I think it's a shorter list. There's still a lot more where we get from our information over and above, obviously, our signals that we are getting from Bloomberg. And that's pretty much the end of my story. I did kind of give you 5 extra minutes. Yeah, and I really hope the message came in through quite clearly. If it did not, don't worry. I pressed the replay button about 24 minutes ago. And for the rest of the 5 weeks, our PMs are going to be replaying, replay until sort of it makes sense for your portfolios. Thank you so much for spending your afternoon with me on a Friday. It's a pity this session is not open to a Q&A, but you can prepare your questions and send them via email. Otherwise, you can wait for us to come to your offices. And where we had to make immediate changes to your portfolios because of market corrections, would have sent you the email so you don't wait for our meeting. So all in all, even if your meeting is 2 weeks from now, you probably have a very good idea via email of what we think should be done. And then you can raise a call, MS Teams, WhatsApp, for any further clarification. Thank you so much. Have a great afternoon. Have a beautiful 2026. Yeah, see you from next week onwards. That's all from my side. I would have handed over to Eugene or Olga at this moment, but they've sort of given me the permission to close the meeting today. So yeah, I'm going to take advantage of this rank promotion and say the meeting is closed as of now. Thanks a lot.